you don't know where to go here. David Kudla's got some thoughts here because he does this stuff for a living. He's a founder, chief executive officer, and chief investment officer at Mainstay Capital Management, joining us via Zoom from Troy, Michigan. It's a lovely town. I've been there once. David, what say you here? I mean, for a lot of investors, that Magnificent Seven has worked so well for so many people. Do you just stay with with that horse, or do you try to maybe look for some value in small cap, mid cap, maybe some of the sectors that have lagged?
Yeah, and good morning, Paul. When we look across the market, and we know that the Magnificent Seven had a great year last year, up about 110%, and we now have a Fab Five that excludes Tesla and Apple that's doing very well this year. And, the concern is, can we see a sell-off? NVIDIA with this meteoric rise, can we see a sell-off in these stocks? Of course we can. It wouldn't be surprised if 5 or 10% or even more at any given time, given the rally that we've had and the Magnificent Seven this year and the Fab Five last year. But, our overall thesis, we like growth over value, and mega cap tech and profitable tech is our most favored sector last year and coming into this year. And we look forward, we look over the next 3 years at the annual growth rate of the Magnificent Seven. It's 4 times that of the rest of the S&P 500. If we look at profit margins, they're going to expand at a lot higher rate than the other 493 stocks. You take out Apple and Tesla, those numbers get even bigger. So we're still on growth over value, growth over value, large over small. We had a rally in small at the end of last year in small caps, a little bit here recently, but small caps, the problem that small caps have, if you become a good small cap stock, soon you become a good mid cap. So you could become a good mid cap stock. So the Russell 2000 by definition has that kind of problem. And in the environment we're in with higher rates, it's tough for small caps. And then finally, we like the U.S. over foreign.
So David, to that point, what do you do then? Like, all those trades are working. All those trades have been working. Do you just kind of put the positions on and then sit tight and then wait for all that to play out?
Yeah, well, the approach we're taking is, yes, we are, very dominant in NASDAQ 100, those mega cap growth stocks. We're dominant there. We're diversified in some other areas and need to be. In the income portion of our portfolio, the thing that's worked so well last year and into this year is holding the ultra short-term bonds with high yields. The bond index, U.S. aggregate bond index, was slightly or only slightly up last year. When we look at these ultra short-term bonds with high yield, up 6 or 7%. So if that's the income portion with this growth dominant portion for equities, that's a formula that's still working for a diversified portfolio.
So, David, I know you prefer U.S. over international markets, but I see you mentioned China here in your notes, and I'm sorry, Japan. And I've heard more about Japan in the last 6 months than I have in the last 20 years. What's going on in Japan from an investment perspective?
Yeah, we've heard more about Japan in the last 6 months than we have in the last 35 years, exactly. Because we're bumping up against that high that was set in December of 1989, when I was walking around the Stanford campus learning about investing, right? I mean, it's that long ago, that giant trough that we're coming into. And Japan has some things going for it. They have still easy monetary policy. They have the capital flows coming from China. China is nearly uninvestable at this point. And then President Trump comes out and says, if he gets elected, I'm going to put a 60% tariff on all Chinese goods. I mean, with everything else that's wrong in China, with Evergrande, their real estate sector, all that, more bad news coming. And, so they've been doing a lot from a stimulus standpoint, but that stock market continues to be, mired in a downdraft. If we look at Europe is near recession, kind of in and out of recession. The UK is in recession, and actually we just found out that Japan unexpectedly got its second quarter of negative growth. But we've just got a easy monetary policy, capital flows there. Valuations are starting to get a little bit lofty, but it's still investable.
What do you make of the BOJ and them getting off of yield curve control? Like, does that factor in to like your thinking? Like, clearly there's a carry trade that's going to unwind really fast. Clearly that's going to affect the Treasury market. Does that affect you, David?
It affects us in that we're watching what the yen is doing, because the yen, it just continues to weaken, and they've come in, they've intervened. The BOJ has intervened several times, but when they do, those tend to be temporary fixes. Those tend to be just temporary in nature. And our concern there, really our concern now, is with the economy in a more fragile state. What will they do in April? Will they finally raise rates? I mean, what they've continued to do while the U.S. went through their massive, 525 basis point increase in rates from zero, Europe raising rates. We have Japan there that's just maintained this easy monetary policy. They've made some adjustments, but they've got a weak currency that continues to weaken, easy monetary policy. And, we'll see. But the moves that they've made have been just minor, almost non-events in terms of if they really started to tighten monetary policy, which they haven't.
So, David, we're about 75% of the way through the S&P 500 earnings. Any themes for you? Any takeaways for you? Any changes to your portfolio based upon what you're seeing?
No, I mean, we're beating expectations again. Earnings coming out better than expected. We're beyond that earnings recession we had last year, and now seeing earnings doing quite well. So, I mean, we're encouraged by that because that's what we want to see with the Fed. Well, we're still concerned about the Fed, obviously, but no, it's really supporting where we're at in terms of growth versus value. I think, as we get into the second half of the year, we think we have some volatility here for a few more months. We get in the second half of the year and we start to see the rate cuts come. If that's June, let's say, that they start, and remember that just weeks ago we were looking at March for rate cuts to start. If rate cuts do start that soon, and I think it could maybe even be longer, then we can come in. Then we can feel more comfortable about dipping into small cap, dipping into cyclicals. But right now, I mean, we're encouraged by earnings, and it's supporting the areas that we like.
Right. All right, David, if I find myself in Troy, Michigan this summer, would you recommend I pay a visit to the Waterford Oaks Wave Pool?
Oh, I love wave pools, even though they're creepy and weird.
I think you should. And if you do, give me a call and we'll go down there and have some fun. That sounds like a lot of fun.
I've been to Troy. I did one of my internal audit visits when I was at Payne Weber to the Troy, Michigan Payne Weber branch. Had a good time there for a week. Good folks out there. David Kudla, thanks so much for joining us. David Kudla, founder, Chief Executive Officer, and Chief Investment Strategist at Mainstay Capital Management.